Hello and welcome. My name is Lunta Di La Paulu and I am the founder of Yeto Accounting and Tax LLC. And today I want to walk you through the process to decide whether or not you should be inclining to form a limited liability company or an LLC or an S corporation or a corporation for that matter. So I will use data, some financial numbers to help us go through a simulation where we can actually have an idea of the tax implication for these two legal structure. So a quick disclaimer, this video, the content of this video is purely for informational purposes, is not and should not be taken as a legal or tax advice. Each person has their own situation and therefore they may need different set of professional advice based on their individual circumstances. So with that out of the way, let me walk you through a situation to actually have an idea in terms of, okay, which legal structure may work better for you when it comes to the tax planning, everything else being constant. Okay, so generally speaking, both LLC and S corporation, if you're following the corporate formalities, they should provide you a limited liability or a protection, which often is very important in the US today because we live in a litigious culture. People enjoy or sometimes even find pleasure in suing each other and going after other people's assets. So these legal structure provide your business and you a separation where if something happens with your business, no one would be able to actually reach to your personal and family assets. So that's why it's important to, one of the many reasons it's important to formalize or incorporate your business. So with that already there, let's look into a scenario. Let's say you have you are planning to start a business and you're forecasting that in the first year of your operation you will incur about $100,000 in revenues, whatever your business is, and you are considering between either going a solo proprietorship without a legal structure, which is really not ideal, especially if you're providing goods and services that may make you more susceptible to legal liabilities, or you're deciding, okay, should you go with an LLC or an S corporation, and you're projecting to make about $100K in the first year of operations. Okay, so based on that, right, you also forecast that you'll be incurring about $30,000 in operating expenses. Okay, so here's one of the key difference between these two or four legal structures. Under a sole proprietorship or an LLC, you're not allowed to pay yourself a salary. It's considered a draw or a distribution to the owner. Okay, so that's why it's not deductible per se to the business. Your business cannot deduct it for tax purposes, and you're not going to pay employee taxes on it either. However, here's the most important part. As an S corporation or a C corporation, you are effectively both the owner of the business as well as the employee in your business. Therefore, you can take what the IRS recommend, a reasonable compensation. So again, a reasonable compensation doesn't really have a definition, but ideally you want that reasonable compensation to be between 30 to 50% of your projected net income. Okay, so with that in mind, as you can see in the formula, I was projecting the net income to be 70,000, excluding the salaries and payroll taxes, right? So I did 50% of that. It could have been slightly lower, but I think it's reasonable for this example. And with that in place, you will be paying both the payroll tax of the employer portion as well as of the employee portion. So the employer portion is deductible to your business. So basically, an S corporation or a C corporation, as you can see here, it helps you to reduce your taxable income, right? Your net operating income is where you get taxed. So here's an example about a situation that I came across with a client. One of the clients that I have used to file their tax return. Instead of calculating the net income, they reported the revenue. And you can already imagine the amount of tax bill they were paying over what they actually should have been paying, right? So with just based on these numbers, we can see a major discrepancy in terms of potential the discretionary income that the S corporation or a C corporation helps you to save in terms of paying taxes. So if we come down a little bit, we'll see that an S corporation does not pay self-employed taxes because you are an employee, and therefore you pay payroll taxes as an employee and not as a self-employed individual. However, unfortunately, for the LLC owners or sole proprietor owner, they have to pay 15.3% of payroll taxes, right? So you can see that it's a big deal of your income already. And on top of that, you have to pay the federal income taxes. And if you live in a state that also have a state income taxes, you can add up to that. So at the end of the day, someone working as a sole proprietorship or an LLC would have a earnings, a net cash flow almost to $40,000. But someone who has registered their business as a C corporation or chose to be taxed as an S corporation would be able to take at least $17,000 more home than if they had stayed under an LLC structure. So this is to say that the legal structure you choose to adopt for your business have a major impact to your business, have a major effect on your company, right? So that's why it's really important to consider these options, because as you can see here, the amount of tax you're paying is about $30,000 a year, while if you go with an S corp or a C corp, you'll be paying only $12,000. And if you do a little bit more tax planning, right, you can actually reduce that amount substantially. And again, if we look into their effective tax rate, the effective tax rate, basically we're dividing the amount of tax you're paying by the total earnings you have, and you're paying about 30.10% annually. And here you're paying about 12.37% under an S corp or a C corp. So you can see that there is a substantial tax saving. And again, I always encourage my client, when you have tax savings, it's not for you just to spend it in or buy other things that will be disposable in 6 months or 1 year. You want to invest. You want to put them either in your retirement or buy assets, or even ideally put it in real estate, because and if you buy a good real estate, it's going to appreciate, it's going to generate cash flow, and it's helping you build your wealth and guarantee assuring you your future retirement. Okay, so this is an example just to walk you through the process that I often walk my client to consider when they either want to change a legal structure, which is called converting to a different legal structure, or for new startups that want to register to a different business. This is absolutely not to say that an S Corp or C corporation are best for every person, for every situation. They have their advantages, they obviously have their tax saving advantages, but there are also many other requirements that you have to comply with to maintain this legal structure. They take a lot of work, a lot of effort. For example, in the payroll side, you will need to hire someone, unless you know what you're doing, to take care of the payroll side, the compliance, the filing of fees, and the filing of the paperwork and so forth. So I hope this mini video helped you get a little bit of a sense on how you can start thinking about your legal structure. But ideally, I would encourage you to visit a professional, find a lawyer or an accountant, a tax advisor, a CPA who you trust, who can help you. And if in your area there is no one that really could help you, feel free to reach us out. There is our email address here, there is our phone number on top, as well as our website, yetoadvisory.com. So we look forward to hearing from you, and if you have any question, or if there is anything we can help you in terms of tax planning or bookkeeping, payroll, please let us know, and we would be more than glad to work with you. All right.